All right, guys. So as was promised, um, we're going to start section 4, which, well, not start section 4, but continue in section 4. Section 4 actually talks about the legal aspects of a business, right? It has three main parts. The first part, it speaks about contracts, right? I do have a video on contracts, so you need to check that out. The second part speaks about insurance, right? And that is what we're going to be looking at right now. And a third part speaks about business documents, right? So the business documents section, I guess I'll try to see if I can facilitate that, but no promises. But let's talk about insurance. All right. So then, insurance is really based on the fact that in life we all face risks, right? We all face risk, both in businesses and everyday life. Some of the risks that we face include floods, fires, hurricanes, traffic accidents, robbery, criminal attacks, serious illnesses, right? So, with all of these risks that we face, right, it is best to protect ourselves from bearing all the burden of these risks, right? Yeah, and then this is where insurance comes in. All right. So, what is insurance? So, insurance is really a system that provides compensation to those who suffer a loss, right? That's basically what it is. I have seen on questions where they ask for you to differentiate between insurance and assurance. And here is the difference. So, insurance is concerned about a risk that might or might not happen. Yeah, right. So when you take out insurance now, or when you purchase insurance, it's a risk that might or might not happen. But assurance is concerned about an event that is bound to happen, for example, death, right? So they normally call life insurance assurance. This sometimes they will say life assurance, but people just say life insurance. In technical terms, life insurance is not really a thing, right? It's really life assurance because it's an event that's bound to happen, and you're not going to be the one to be compensated in life insurance, right? It's really um, your beneficiaries, right? So it's life assurance. So that's the difference between insurance and assurance. So insurance is based on a very important concept that is called pooling of risks, right? So let's talk about pooling of risks. So pooling of risks is really a concept that states that instead of one person standing to bear all the loss in the event of an unfortunate event occurring, right? What will happen is the loss will be shared amongst a group of people, right? Um, so that one person don't have to bear that loss, right? So they will contribute money towards a pool, yeah, so that if somebody from the pool suffers a loss, then money can be taken from the pool to help. Let me give a more practical example, right? Sometimes in classes, right, the form teacher would collect money from students per day. We call it like class dues, just in case somebody loses their lunch money or they lose their bus fare, right? That would be a perfect example of what pooling of risk is. So all students in the class, they suffer the same risk, right, of losing their lunch money or losing their bus fare. And so, in collecting a small amount of money per day, class dues, right, the form teacher, is able to help students when they lose their lunch money or their bus fare. That is the concept of pooling of risk. You following? All right. So let's look at some principles of insurance. The principles of insurance are really put in place to ensure that people do not really profit off insurance, because you have unscrupulous persons out there who will try to profit off insurance. So let's look at them. So we have insurable interest, utmost good faith, indemnity, contribution, proximate cause, um, subrogation, and average clause. Average clause is not really so much talked about these days, right? So, insurable interest. So, insurable interest is really a principle of insurance that states that the person that is taking out a policy must suffer some form of loss, right, if the thing being insured against occurs, right? So say for example, Stacy can insure her own house, right? If it burns down because it's her house. If the house burned down, then she stand to lose. You get what I'm saying? But she can't insure somebody else's house down the street because she does not have an interest, right, in that house. And what that means is that if that house should burn down, it's not hers. She does not stand to lose, right? So this is very important, a very important principle, right? Because then people could be profiting off insurance if they could insure stuff that they don't have an interest in, right? So they would just insure it, then destroy it, and then get the money off it, right? So then we have the next one, utmost good faith, which means that the person who is seeking insurance must disclose all relevant facts pertaining to what they are insuring, right? And then we have indemnity, right, which is a principle that aims to restore the policyholder to the position that they were in before the accident or the illness or the damage, whatever the damage is, right? This principle seeks to restore, to put the people back in the position that they were in, right, before the damage occurs, right? It prevents people again from making a profit off insurance. And then we have contribution, which is another principle of insurance. You have persons who may have multiple insurance companies, right? Multiple policies with multiple insurance companies, and sometimes these policies may overlap, right? Which means that they are insuring against the same thing, right? So you have an insurance with company A for your building against fire, and also with company B for your building against fire, just the same. Now, say for example, your building burns down, unfortunately, right? What both companies will do, they will work together, right, to pay back the amount of money that you would have suffered a loss in damages, right? So say for example, the damages total to say $1 million. So both companies will work together to give you back that $1 million, right? And you can see obviously why this will prevent someone from profiting. Can you imagine if both companies were giving you $1 million each, right? Then you would gain $1 million from the damage to your building, right? And so the principle of contribution is where both companies will work together to make payment or to compensate you. Then you have proximate cause, right? So proximate cause, it really states that a claim will only be honored if the loss suffered is as a direct result of the insured risk happening. So say for example, you insure your building against theft, right? Theft. And your building burned down. I mean, okay, you can't go to the insurance company to claim that. Yeah. So your business caught fire, and because of that, people go in and they steal, some of the goods that were not burnt, right? You can't claim for theft because the the reason, right, for the theft is as a result of the fire, right? And so the cause is not proximate, right? So the theft, right, is not like the people break down your building and went in and stole your stuff, right? The building was already broken down because of the fire, right? So you cannot claim in a situation like that. All right. Um, Subrogation. So this is an aspect of indemnity, and it means that really the insurer takes the place of the insured. If your car was completely wrecked in an accident, the insurance company would compensate you, right? But they would keep the wreck. Otherwise, you, the insured, could sell the wreck and you would make a profit, right? So what they will do is they will keep the wreck. You get what I'm saying? They'll keep the wreck so that persons don't profit off it. Yeah? And yeah, so that is what they'll do, right? Very important point to note, right? Then we have types of insurance, but I need to go back to something, guys. I need to go back to something. right? When we talk about pooling of risks, right? Now, I did not say this. The money that is contributed to the pool, remember we say it's pooling of risk, persons contribute to a pool, persons who have similar risk contributing to a pool, right? Now, that money that is contributed to the pool is what we call premium. So when you take an insurance, when you take out an insurance policy, right, you will have to contribute money towards a pool, right? And that is what we call insurance premium, right? That is important for you guys to remember. It is called insurance premium, right? They normally ask that question on the multiple choice, so please pay attention to that. All right, so we're moving on to the types of insurance now. All right, so we have life insurance or life assurance. We have marine insurance, fire, motor van or aviation insurance. We have accident insurance, personal accident insurance. And then we move on to this thing here. I've seen this on a question where they ask how insurance facilitates trade, and so I just dropped that in. Right? So insurance facilitates trading in many ways. When we talk about trading, we're talking about the buying and selling of products, right? Yes, goods. So insurance companies, they encourage trading by taking on many of the risks that firms would have to take on, right? You will feel much better to know that, okay, just in case something unfortunate occurs in your business, you're covered by an insurance company, right? Traders are not afraid to send your goods far distances because they will be compensated should an unfortunate event occur, and this increases or encourages trading, right? Insurance companies provide a source of capital, right? They are also investors. Yes, insurance companies do invest in other businesses, and so it stimulates trading. Insurance companies also provides buildings, offices, plazas, and shopping centers. A lot of insurance companies are big businesses, right? And so they will sponsor, support, and build plazas and offices and buildings that will encourage and contribute to trading. So, guys, that's insurance for now, right? So please remember to check out the other video on section 4, which is contracts. Also, right, check out my playlist, right? Share the channel, subscribe, leave a comment if you like it, and hit the like button. All right, thank you. Wow, good. See you soon again.